Helping out family with a place to live, it feels great, doesn't it? It seems like such a simple, kind thing to do. But what if I told you that simple act of kindness could actually cause a huge headache with HMRC? Well, today, thanks to our friends at My Tax Accountant, we're going to pull back the curtain on the hidden tax traps of renting property to your relatives right here in the UK.
And that really is the question, isn't it? In your mind, you're just helping out, maybe giving your son or daughter a leg up. But from HMRC's perspective, they might be seeing something entirely different. So let's figure out exactly where that line is drawn.
Okay, so this whole thing really boils down to one single concept. It's something called an uncommercial let. And honestly, it's a trap that so many well-meaning landlords fall right into without even knowing it exists. Getting your head around this is absolutely key.
See, in the eyes of the tax office, there are two totally separate worlds of renting. You've got your standard commercial let. That's where you charge the going market rate, and it's pretty much business as usual. You claim all your allowable expenses, and hey, if your costs outweigh your income 1 year, you can declare a loss. But the second you give a family member a discount, it flips over into an uncommercial let, and suddenly the rules change completely. Your expense claims get capped, and that ability to declare a loss, poof, it's gone.
So what exactly is an uncommercial let? Well, the official definition is pretty straightforward. It's any rental deal that isn't strictly business. And the classic example, the one we're really digging into today, is when you rent to a relative for less than you could get on the open market.
Let's make this real. This is an example straight from the government's own guidance. So meet Jane. She's renting a flat to her sister for 300 quid a month. That's £3,600 of income for the whole year. Simple enough. But her actual expenses on the property, things like insurance, repairs, service charges, they add up to £4,000.
And boom, there's the trap. Because this is an uncommercial setup, Jane can only claim expenses up to the amount of rent she received. So she got £3,600 in rent, which means she can only claim £3,600 of her $4,000 in costs. That extra £400, it just vanishes into thin air. She can't claim it. It's lost.
And this is the absolute line in the sand from HMRC. This quote says it all. You can use your expenses to wipe out your profit, bringing it down to zero, but you are not allowed to create a loss. That $400 doesn't get carried over to next year. You can't offset it against another property. It is just gone. A little financial black hole, all created by doing a good deed.
And if you think that's the only catch, I've got some bad news. The income tax part is really just the tip of the iceberg. The truly nasty surprises can pop up years down the line when we start talking about things like capital gains and inheritance tax.
So let's fast forward a few years to when you decide to sell the property. Any profit you make, that's the gain, above the annual exemption, which is just £3,000 right now, gets hit with capital gains tax. For the 2025-26 tax year, we're talking about an 18% tax bill for basic rate taxpayers, and that jumps all the way up to 24% for higher rate taxpayers.
But here's the real kicker. There's a tax relief called Business Asset Disposal Relief, and it can slash your capital gains tax rate to a much more palatable 10%. The problem? To qualify, HMRC needs to see a rental as a genuine business. And you can probably guess where this is going. They are very, very unlikely to view a discounted family rental as a commercial business. The result? You could miss out on this relief and end up paying more than double the tax. A costly mistake.
Oh, and it gets worse. Let's say you go even further and let a family member live there rent-free. HMRC can see this as a gift with reservation of benefit. It's a fancy legal term, but it basically means that while you've gifted them the use of the property, you've kept the benefit of owning it. If HMRC decides that's the case, the entire value of that property could be added back into your estate when you pass away, and your family could be looking at a staggering 40% inheritance tax bill on it.
Okay, I know, that was a lot of doom and gloom. You're probably feeling a bit nervous now. But don't be. The good news is that all of these problems are completely avoidable if you just take the right steps from the very beginning. So, let's walk through a simple checklist to keep you safe and compliant.
So, how do you do this right? 4 easy steps. First, figure out the actual market rent for your property. Do your research. Even if you charge less, you need to know this benchmark. Second, get a proper tenancy agreement in place. Yes, even with family. This proves to HMRC that it's a formal arrangement. Third, and this is non-negotiable, you have to declare all the income you receive. And finally, keep meticulous records. Every single penny in, every penny out. If there's ever a question, good paperwork is your best friend.
So look, those are the fundamentals. But of course, every family situation is unique. Trying to navigate all these rules by yourself can feel overwhelming, and, as we've seen, the price for getting it wrong can be incredibly high. That's why, honestly, the smartest thing you can do is get professional advice that's tailored to you.
If you're sitting there thinking, I'm not sure about my setup, then please, get some clarity. The team at My Tax Accountant specializes in this stuff. You can reach out to them for advice that fits your exact situation. The details are on the screen. You can call or even WhatsApp them on 07854 255 375, or just shoot an email over to info@mytaxaccountant.co.uk.
So, I'll leave you with this one question to think about. Is your family rental agreement built on solid ground? Or could it crumble under a little bit of scrutiny from HMRC? When it comes to tax, it's always better to be safe than sorry. After all, protecting your family should also mean protecting your finances. Thanks for watching.